We focus on creating lifestyle assets, cash flow, and building wealth for our investors through short-term vacation rentals, the larger homes. No competition because you can't put two families or even one family in a hotel. So people tend to buy a bunch of roofs and it ends up being way more expensive. Now, personally, I own almost $10 million in assets here outside of Houston within 65 miles of my home. But if you diversify, right, what's going to happen is you're also diversifying the way that income comes in. It's like having different product lines, and if one revenue stream slows down, the other one might. Is if you can build a home into a mini resort, that's where people pay you the top dollar, right? People can go in there and spend a whole month if they want, hang out there for the summer, bring their family, play, there's hot tub, there's pool, there's toys.
Welcome to another episode of Real Estate Development Land to Legacy. We have George Salas with us today. George, welcome.
Man, Eugene, thank you for having me. It's a pleasure.
Always fun chatting with you, George. So tell me, what is it that you do?
We focus on creating lifestyle assets, cash flow, and building wealth for our investors through short-term vacation rentals. We've got a special type of vacation rentals that we focus on, we specialize in, and it's a larger, well-amenitized, unique experiential type of property. So they're a little bit different than 99% of the short-term rentals out there.
Okay, so educate me a little bit. What's a short-term rental?
I love it. Yes. This is a great question because we started talking about short-term rentals immediately, but definitely let's break it down. Short-term rentals are rentals that you are doing, whether it's part of the room or part of the entire place, that are rented between 1 and 30 days, right? So 1 and 29 days, that's actually considered short-term rentals. Now, the loss of long, midterm, or short-term rentals differ in every state, but what we consider in the industry short-term rentals is 30 days or less.
Okay. So it's not like I guess I'm trying to understand, is it usually like a standalone one, like a house or one unit apartment condo, or I guess let me rephrase. The way I typically think about short-term rentals is, your typical Airbnbs. And I used to think that Airbnbs is when, or the properties that are listed there is when somebody owns a place that they don't use, usually like a vacation house. And when they don't use it, they throw it on Airbnb, rent it out, and then otherwise it's just their thing. Recently, as I started learning that people actually own multiple of these and that's their business. Is this what you're doing?
Right, that's right.
Is your model a little bit different?
I want to create something that's going to be impactful for myself and my family. I went into hospitality for 10 years. And then at year 9 or 10, I was like, man, this thing is really not working out for me. I had invested as a limited partner into a deal and it went south. It didn't work out. So I had to restart over. And that was my dream of being a business owner. And that's when I went into real estate. Right. So it's been since 2018-ish. I've done over 130 deals over the last few years, and 5+ of those have been short rentals. But I started, Eugene, doing these smaller apartments. I would rent them and I would sublease them as short-term rental operators as a marketing platform. Right. So our model is going in, specifically finding 4 bedrooms plus, 4 to 7, tops bedrooms, larger homes with larger backyards, amenitizing them depending on like what market we're in with higher end amenities such as pools, hot tubs, outdoor kitchens, outdoor saunas, covered patios, TVs, pickleball courts, that sort of thing, and which create for us what we call experiential investing or lifestyle investing, right? Because you're catering to an audience that love the model of spending time in these larger homes, phones or in the office. The millennials have a tendency to really, it's the largest group right now, to really want to spend more time in these properties that are larger, nicer for their families, right? So think of you traveling. We love these larger homes. So now as the industry pivots into more of a professional industry, we're coming in and catering to where the industry is going, where the puck is going. right? So does that make sense? Did I leave anything out there?
Yeah, no, I think it makes sense. It makes total sense. So the who's the typical target audience for your customers? Who stays there?
Well, there could be tons of different audiences, right? We like to target 1 to 2 avatars, maybe 3 per type of property that we create. So our favorite is going to be families. Why? Because when a family or two gets together, when they have children, they have the husband and wife, they have the grandma, and they come and stay at one of our 4 to 6 bedroom properties, they're able to split the cost so it becomes more affordable. So we create affordable spaces for larger groups, aka families, and they're able to enjoy those spaces with their family. So the second type of avatar that we love are they're going to be working travel groups that do working staycations type of thing. They come for a week, they come for 2 weeks or a month. I love those because they come in, they're out of the house all day, they pay you top dollar, their company's paying for it, and they don't mess the house up. The third one I'll say, we also love the groups that come in just for a special occasion, but those are going to be, they also pay high dollar, but they're going to be a little bit rowdier, right? So create a little more trouble there. Right? Every property creates a different style avatar. The trick here is targeting who you really want. That's going to pay you the top dollar in whichever market type of property you're investing in.
Okay, that's amazing. So, as a developer, I am listening to you and I'm like, all right, well, that sounds like there's demand. It sounds like there's business out there. How can I create more properties like that? Do you typically buy existing properties and convert them into vacation rentals, or do you develop what should I do as a developer? Is it a good market for me to go into?
Yeah, absolutely. So that's a fantastic question. So we are working on a potential deal that would be our first development acquisition, right? So now for a developer that if you keep some of these and you refinance them after building them and developing them, that and a great way for you to enter this market, I'll say is finding these secondary, like smaller city markets that are solid are in terms of travel and hospitality, but they're not too expensive that they become too expensive to make any money, right? But when you do develop, I mean, you're able to acquire equity on the front end. So instead of selling that, obviously your refinance is going to be at 70% ish, right? And so you're not going to make that profit because you're not selling, you'll be refinancing it. So if you wanted to do a strategy that was long-term, for us, developing looks very enticing. And I would recommend it, potentially not for every deal, because we've got to pay the bills and we'll always got to create cash flow to run the business, right? So, but I would recommend staggering maybe like one project or a percentage of every project to throw in there and keep a short-term. Also, if you're building a condo, like right now, let me give you an example. The 23 townhome development with a 33 townhome development right next to it and a large, maybe 2.5 acres of land in the middle. It's in Nashville. It's very close to the water. We are in the pre-due diligence stage. And for us, I saw this project and I was like, okay, development project, we would refinance and build in quite a bit of equities, which is great for our investors. And then we would turn around and the plan for the developer was to come in and do more units and do like just tons of units with maybe some space for amenities. But for me, was finding the equilibrium is where we shine best, right? The equilibrium between how many units should we put in there and how many amenities in order for us to get the best returns, right? So for a strategy such as, hey, I'm going to develop this and sell it, I would say maybe put more units because you're going to get more for the dollar, right? For a strategy that's more of a long-term buy and hold, turn into short-term rentals with a potential second or third exit strategy, right? And I would find equilibrium and leave not as many units, but leave more space to put in beautiful experiential amenities that people are going to love. So for us, this project is something we're targeting, and we would be developing a resort-like amenity package in the mid. That's what we're doing in the next 6 to 12 months, right? So does that make sense?
It makes perfect sense. So you're looking at buying this entire townhouse development and rent out every unit as a vacation rental. Is that right?
That is correct. So probably wouldn't do all 23 plus 33, but I would say most of it, yes, maybe somewhere between 30 to 40, right? If we're able to get the amenities in the middle. Now, right now, the approvals are like, I think about 30 are approved by the city for this project, but we are still in the process of due diligence. But yes, we would rent these as short-term vacation rentals.
Okay. And then how does that compare to, let's say, a true limited services hotel, I guess, where they market it as such, as an actual hotel versus an independent vacation rental? Are there pros,
Absolutely.
cons? Does it make sense for you to brand it as, some sort of a, I don't know, extended stay or something like that?
I love the question. So I would say if you want to compare it to a hotel, you can't compare the larger 4 bedrooms and up, which is our niche. Now, if I was building an apartment complex or I was buying an apartment complex and I was turning those into short-term rentals because of the size, those are very comparable. So now those units are competing directly with these hotels. The larger homes, no competition because you can't put 2 families or even 1 family in a hotel. So people tend to buy a bunch of other roofs, and it ends up being way more expensive than if you were just getting these homes where people can gather, socialize, and create those experiential moments, create those emotions, that connection in between. So for us, I would say we would brand it and market it as its own resort type of place. I like to call it mini resorts or micro resorts if we're going to build something like that, right? And we like to brand these places as their own, right? So they would have their names, they would have their website and everything on their own. And they would not just be rented on Airbnb, VRBO, and all the other online travel agencies. We would do tons of direct marketing, targeting the people that come in, doing retargeting with our ads, et cetera, et cetera.
Okay, perfect, perfect. That makes perfect sense to me. So, if I'm looking at developing something like that, and my design brain just keeps spinning right now, if I'm targeting a family, I suppose a house is a house, townhome is a townhome, family dynamics, probably a typical residential design might work. But if I'm thinking of targeting business travelers or maybe these groups of co-tenants, whether it's vacation friends and whatever, now I'm thinking, well, maybe it makes sense to redesign it slightly, make sure that every bedroom has an ensuite bathroom, maybe minimize the kitchen because I'm guessing these groups aren't going to be cooking there a lot. Are these the type of things that you're considering that would go into design if you were to start fresh, start new?
100%. We consider in every single house, and we would consider in a development project like this, right? So what we would want to do is I know that we are utilizing these for vacation rentals that people are going to be coming and staying by the weekend or by the week. We want to have a perfect blend, Eugene, right? And the perfect blend is where to what point do we minimize the amenities you mentioned so that we can attract and utilize this space with more flexibility and with more purpose? And that still leaves the idea, the concept that we're going to utilize this for 5 to 7 years. And then someday they might turn into long-term rentals or we might sell these to families, right? So we want to leave that in the middle. So what we do for them is stick with the long-term rental sort of goal of design, but add features like super designer walls, really cool, like more flexible that are amenities that are not attached to the structure. But yes, every room having a master suite and potentially, like adding a hot tub on in a rooftop for every single condo we're building. Like this project was built specifically for it is being built specifically for short-term rentals. So almost every property has a hot tub on the roof, right? So like that is one of the biggest attractions for short-term rentals. You wouldn't do that in a normal build out. And it has a rooftop. And specifically because people love the view part, like that is an amenity. Having a view is a huge amenity and it's an ROI based amenity. So I would stick in the middle and be super strategic about what I'm doing so that I can have a secondary or tertiary exit strategy if things don't work out. And I want to leave enough room for us to consider and pivot if needed.
Interesting. So, for your business model, what is your typical exit strategy? Do you package it up and sell it as a business? Or you mentioned potentially, if it's a house, you could just sell it as a house. And if somebody wants to live there, then they could. Uh, what do you typically target, and where do you see better returns when you exit?
Absolutely. So as of right now, we are in the process as we build the fund that we have, bedrooms and up. We're packaging portfolios, all very specific. 4 bedrooms and up, larger backyards. They're all going to have some type of feature. Not every single one of them hot tub, but they're going to have features that make these properties unique. Right. Our goal here, we're reverse engineering the entire thing, right? So as you probably already do this for your own business, you want to always start with the end in mind, right? How am I going to exit this thing at the maximum value possible? The greatest investors know and understand their market, but they also know and reverse engineer their entire vision. Vision is one of the biggest things that we have as a company. So we do is we reverse engineer, and right now we're targeting companies that are more on the institutional level. So I would say companies like MetLife or private equity that are invested in real estate, that buy these portfolios. And what we're doing is you're going into markets that are slow growth, aka we call them recession-resistant, meaning smaller, slow growth in terms of hospitality, in terms of real estate, not too volatile, in terms of the last 5 years of short-term vacation rental data. So once we do that, we now have a very steady portfolio that's going to be growing over the next 4, 5, 7 years. And when we exit, we're going to take the NOI, we're going to show it up to the buyers. And what happens with these buyers, these larger asset buyers, they're not going to buy one portfolio. They're going to come in and want to buy 5 to 10 portfolios, equally 100 units, and that's $100+ million to $150 million in assets. And they're going to want to see NOI that's very slow to grow and not a whole lot of volatility, no drastic changes. They're going to want to see specific percentages that are capped on your operating costs. So we know all this because we're reverse engineering our exit strategy, right? And that's exactly how we're mirroring, right? Now, as we go and switch things up, as long as we have that in our mind, we believe that it's going to work for us. Now, personally, I own almost $10 million in assets here outside of Houston within 65 miles of my home. And most of the properties that I've exited have been asset sales. So we've not exited a portfolio, but we're absolutely targeting to exit portfolios rolled up and bolted on into one big package. Good?
Amazing, amazing. So
Yes.
when we and we do it all the time. My focus is mostly multifamily, and we do it all the time. We first figure out what is the exit strategy, what is the cap rate, how much is it going to be worth, and then we back into, well, what do we have to build it for? And it's always a push and pull. Do we build apartments with balconies, with decks, or without? Do we have operable windows or not? Do we have air conditioning or not? And we evaluate, everything, every cost has a corresponding revenue with it. People pay more for balconies. If you ask me personally, I never use my balcony. I don't know why it's there. It's a waste of space. I felt like I had to put a chair there just to have it there, but I never walk out there. So if you ask me personally, I don't care about it. I don't want to pay, extra $10,000 per balcony just to put it on the building. But we have to ask the market. And the market tells us
Exactly.
that people are paying more for units with balconies, whether they use them or not. It's just like, a lot of times fitness facility. People like the idea of having a gym in their apartment building. 80% of people don't use it, but when they sign up, they're like, oh my God, I'm going to go to the gym. They don't, but they pay for it.
I love it. So some ROI focus amenities. That's what it's all about, right?
Amazing. So, what about returns? What do investors expect to see when they invest in vacation rentals like these?
Absolutely. So we target 20% total IRRs and up. So some projects will do more, some projects rarely will do less, but cash flow of 10%, and up as well. So cash on cash, 10% always higher, and IRRs of 20% to 25, I would say is very realistic. If the cash flow is less, it's because you're doing too much luxury, so we like to stay right there. I think being 3 to 4 points more than our multifamily, right? What everybody invests. We're a few points above that, but we're not too unrealistic. If you go there and promote and market like, hey, I want to give you 30% returns. Nobody's going to believe it. But right now, we're marketing between 20 and 23% IRRs, depending on the amount someone invests.
Amazing. I mean, 20% IRR is a healthy return, in my opinion. But what about the risk? Is it more risky than a multifamily, than an apartment development, or a rent to own single family?
Yeah, fantastic question. I love that we're going there, by the way. In my opinion, if you are strategic about what you're getting into, and that's why what we do is recession-resistant market. Okay. And what I mean by that is if we're going into Las Vegas or Scottsdale, Arizona, or Denver, Colorado, right? We know that these cities are high price. Real estate prices have gone up 20, 30, 40. Even Houston is a lot more conservative and steady, but it's still pretty high. So what we do is we take an approach of doing research on the last recession's prices. What happens in some of these cities is that, like you have slow growth between 2007 to 2012, slow or no relative growth of year over year, right? So we tend to go into slow growth or markets that are just right there in between that 1 to 5% or maybe 4% growth, instead of going into the markets that are averaging 6, 7, 8%. So that gives us an edge when it comes to being less risky, right? That's one of the ways that we take the risk away. Now, the other way is utilizing the same data, but looking at the other sector, which is the other half of the business. It's looking at hospitality data from 2007 and 12 in that same market, and looking at the short-term rental data and how the revenue supply and demand has increased or decreased over the last 5 years. The reason why we take both hospitality and short-term rental data is because in 2007, there was no vacation rental data because it started coming out in just 2015, less than 10 years ago. Those things, along with having a very niche strategy, buying right, creating higher cash flow, allows us to have less risk. Also, we go into secondary markets that are not just slow on the growth, but these secondary markets also allow travelers to travel to these markets if a recession was to happen. So, for example, like Houston, right? So when COVID happened just a few years back, people still drove to Galveston Island. It was the best time. Suburban, higher end, outdoor, drivable, mountain markets, river markets. Now, what was dead and closed were places like Hawaii and Aspen, Colorado. Well, I don't know if it's spoken out, but I know Hawaii was closed. So why was it closed? Well, not only because they're not going to travel in a form of an airplane flight. They're not going to fly out. So these are called national markets. So we don't go to national markets. We go to region, right? And regional are a little bit more recession resistant, but still, I would say there's still majority of the clientele coming into these markets are going to be travelers. But most people don't stop going on vacation in a recession. They stop spending flight time, money, and buying expensive hotels. They still drive, right? Because that's one of the things, most people think it's like, hey, you're in a market where there's a recession, travel's going to slow down. Well, no, not specifically. Travel's going to slow down to the far places that you have to fly, national, huge markets, but it's not going to slow down to these closer, like an hour away type of places. And those are the ones we invest in. Like, let me give you an example. St. Louis, Galveston Island, Houston, Texas are some of the places we're investing. We're in 14 different cities.
No, it makes perfect sense. I mean, I get it. COVID hits, all the airlines are shut down, the hotels are shut down, but individual houses, you don't have to deal with the reception desk. You don't need to deal with common hallways. I would imagine you have some sort of a remote check-in system where people can pick up their keys and they're driving. So yes, that makes perfect sense. What happens with, you mentioned recession resistant, and hopefully rates are coming down today again, and we are going to be coming out of, I don't know, right now it's not technically a recession, we call it a slowdown, right? But in a traditional recession, when discretionary income is lower, when unemployment is higher, how do you manage the slowdown on just regular discretionary spending? Because I would imagine even if it's a vacation to a driving destination, demand still slows down.
Yes. And we do that by diversification. your riskiest is going to be your national markets. So we invest in metro, like St. Louis is a metro market, right? And then our secondary markets are going to be more regional mountains, right? We invest in those too. But as you diversify, right, what's going to happen is you're also diversifying the way that income comes in. It's like having different product lines in a company, and one is more secure than the other. And if one, our revenue stream slows down, the other one might sustain it. So we diversify. We try to make it as uncorrelated as possible. But again, we're within the same industry. So for example, how we make it uncorrelated, Eugene, is targeting a family in a city is going to be completely different than targeting the same family on the beach. So targeting traveling workers and business travelers is a completely different, type of client than somebody on a river. So if we diversify the types of property and the avatars, we're also diversifying the income. And that's what we're doing when we're buying a portfolio in St. Louis, which is a city that has a good amount of travelers. We're buying portfolios. We're looking at Nashville, which is a town where vacationers go in, and you have a lot of spending right there in the downtown area of Nashville.
Amazing. Yeah, that diversification is the key in any investing. That makes perfect sense. One thing I wanted to ask you, George, and this has come up in our conversations a lot with multifamily. Somebody was just recently asking me if they could take this one condo building and buy a few units as investment properties, and they wanted to know about daily rentals. If they could, I didn't really know the answer. What does one need to know? Is there regulatory? I mean, obviously run the numbers and so forth, and probably pull up some of the reports to analyze supply and demand. But what do I need to know in terms of regulation, municipal regulation, local regulation? How complex is that market right now?
Yeah, absolutely. I mean, it is, if you're in a metro city that has not had too many vacation rentals until the rise of Airbnb, then I strongly suggest that you do look up the regulations. And it's really easy. All you do is put the city and short-term rental regulations. Now, when you're in a condo, it's a completely different game. So when I was on a phone with an investor yesterday, and he's like, oh, on another note, I've also got my parents, she's in hospice, and then I've got this home that I want to put in. It's in San Diego, and then he's like, hey, what should I do? It's like the first thing I tell him always is, first of all, look up the regulations for your city. Second, look up the regulations for your HOA, right? So a condo is going to have an HOA, right? Unless you own the HOA, most likely I wouldn't even touch it. I don't do condos anymore unless I own the entire project, right? And I don't do these like smaller units. Anything that we do, I'm even getting away from anything 3 bedrooms and below. So anything we do is larger now. I would say just make sure you look up their HOA and regulations before you even do any type of research, because if they're going to deny you, then you're going to be wasting your time, right? So now if those are allowed, there's so many platforms to utilize to be able to do your market research. There's some that are like market wide, like STR Insights or STR IQ, right? New York platform. There's one that has sort of an individual look at the market, also look at the data of per property. It's called All the Rooms. And there's worldwide platforms like AirDNA, which give you skewed data a little bit because it's older, it's scraped. You've got to be really careful and understand how it's filtered to use platforms like that, right? So what we do is we combine, right? Because at the end of the day, if 2 or 3 platforms are going to say the same thing about one listing, we're going niche, brother. Like imagine, taking an average of 100 properties. Like that's not how we do our research at all. We want to get to the T, what amenities, the number of bedrooms, how many people are sleeping, and then what type of amenities are in that property. What's the area? Because you could be on one side of the street and have another property across the street. When you're analyzing, have a property right across the street or 2 blocks down. And if you miss those amenities that he has, and you assume that you're going to make just as much money as this other competitor, you could lose out. And for me, thank God it was a rental arbitrage deal. This is when I first started 2019, when I first was doing these full market research. And I'm like, what did I miss? Because this property, I thought it was going to make $100,000, 90 to 100 grand a year, but it's only making barely 60K. So I'm barely breaking even. And that was a lesson learned. And that's when, I was like, okay, well, this one, it's kind of, I got to niche it down. Just like when you're looking at real estate comps, right? You got to niche it down to the T. Mhm. So,
Amazing. Amazing. I would imagine it's probably hard to mix if it's a larger development, whether it's standalone or multi-story. It's hard to mix this transient population with more permanent, right? If families live there full time, they probably don't like new guests checking in and out next door. So
yeah.
you probably want to look at some sort of a separation there.
Yes, I'll say a question that you got to do an analysis on a case by case basis. So yes, I do agree. Be respectful. We have many properties in neighborhoods, and the way we operate, Eugene, is with rules, regulations within our own properties. And for the most part, people do respect them, but you always have this one group that it's a troublemaker group. So I agree to a certain extent. I mean, a lot of the properties we invest in don't even have HOAs, right? So, which is easier, but we also make friends with the neighbors. Our property management team, which is an in-house team, my wife runs all of it with a bunch of VAs and boots on the ground and local people here, right? And we are able to create a relationship with the neighbors, and, like our team has their phone numbers, that sort of thing. Because you still want to create a little community because they look out after your property, right? And then if they need a place to stay, we have neighbors coming in. Like if there's a hurricane down here, we have neighbors from that same neighborhood. They're like, oh, I saw your property was here. I live in the same neighborhood. I'm going to stay there. They'll rent it for like a month, that sort of thing.
The key thing that you just mentioned is building and maintaining relationships. When you maintain relationship with your neighborhood, with your service providers, it always guarantees your success no matter what you do.
We'd love to hear some more about what you're doing.
Yeah, I mean, we're primarily focused on multifamily. We do have one of our future developments in the pipeline as a resort development. I know very little about hospitality. We had a hospitality concept a few years ago that we studied and went through early design stages. So I like to say I know enough to be dangerous. I've been learning a lot about hospitality industry recently and looking up the reports and figuring out how it works and what amenities are needed and are in demand. It's an exciting industry.
Yes, I love it. Yeah, when it comes to resorts, that's a whole nother animal, right? Because that is 100, for vacationers, right? So you're on a whole nother category of hospitality there, right? For us, we've diversified and that allows us to be a little more safe. Maybe one day we'll jump into these resorts. Right now, micro resorts is our next step. Micro resorts, 7 to 20 units on a body of water, was still managed the same way. A large resort, a whole nother animal with the staffing and the food and the beverages, the alcohol, the bars you have to put in there. We're getting into a much more complex side of the hospitality industry.
Right. And that makes sense. I love looking at the neighborhood and what amenities the neighborhood provides sort of natively. If there's a restaurant next door, if there's a little convenience store next door, if there's a fitness facility nearby, I don't need to own them. I don't need to operate them. Let it be somebody else's headache. But if we could offer that as an amenity to our guests or to our tenants, it's always less expensive for us because I don't need to build a fitness club in my building if there's a gym across the street.
Yeah, exactly. And yeah, if you think about is if you can build a home into a mini resort, that's where people pay you the top dollar. Well, we have several like all tens of properties that we get in the high times or between $800 to $1,200 a night. And it's incredible. 4-bedroom houses, 2,000 to 3,000 square feet, right? And you don't get that all year long, but I'm talking about 4 or 5 months straight, averaging $800 to $1,200 a night at 70-80% occupancy. So you could really create some nice income. It's all because of what you create, right? We just launched the property recently. It has a pool with waterfalls, 2 cabanas, a covered patio, a bar, a playground for the families, grills, and then we changed the garage completely into an additional master suite with its own bathroom, and it's detached. So what else can you ask for, right? People can go in there and spend a whole month if they want, hang out there for the summer, bring their family, play. There's a hot tub, there's pool, there's toys, there's, kids' toys, there's a playground. And then they go back to sleep inside and it's comfortable, right? So, and that's why people pay you those top dollars, right? Because it's different, it's unique. So,
yeah, that's amazing. I learned so much today. George, thank you very much. Definitely a valid and interesting niche for real estate investors and real estate developers to consider. George, if somebody wants to invest in your projects, what do they need to do? Where do they find you?
Yeah, absolutely, brother. Thank you. Empress Capital Group.com is what our company website, and there is a page there for somebody to check out the webinar, right? It's a sub page, but that's where all the stuff is. And then if somebody wants to connect with me directly, George Salas 360.com. Thank you.
Thank you, George.